Welcome, everyone. You're here for the three biggest killers in retirement: risk, fees, and taxes. Now, I'm Imran Razvi. This is Daniel Razvi. He's a tax attorney. And we're going to talk to you about it. I'm going to ask Daniel a question. So, risk-wise, you have to take a risk in order to get a reward, right?
That's what they say, no risk, no reward. But that's a sort of a myth. In many cases, taking less risk gives you a better result. So it's not always true. Sometimes it's true, sometimes not.
All right, we'll talk about that. And then fees. What is a good fee to pay? Is 1% fee okay to pay?
Well, that's kind of on average what advisors charge is about 1% of your assets each year, but we'll show you how that can really eat away up to 31% of your growth over time.
Wow. And then finally, taxes. We got to pay taxes. There's nothing more sure than death and taxes, right? So what can you actually save in taxes then?
Well, if you're working with the proper tax attorney, you should be able to save over $1 million in taxes. That's what a lot of our clients have saved, over $1 million in taxes by working with us. So we'll talk about that as we move forward here. So first of all, let's get started here.
Ben, where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses.
But it's okay. It's part of the game.
No, it's not. It's not fun.
It's not fun to what?
It's the worst part of the game.
Is what?
Taxes.
Taxes.
Yes, that's how it feels like for us sometimes, isn't it? You worked your whole life, you worked hard, put it all away, they've been taxing you all along, and now they want more taxes. So
exactly.
Let's figure this thing out.
All right. So here's who we are. I'm here on the left. This is me and my wife and our two kids. And I am Raz's eldest son of 13.
So I'm on the right with 13 kids, and Daniel is the eldest. And we did, we do know how that works. So that happens. People ask me all the time. But we had 5 birth children and 8 adopted children, and that's our 13 kids. And now I have 4 of them are married, and I got 6 grandbabies now. When we're not doing this, we have Conquer by Love Ministries. It is a nonprofit organization that we started about almost 20 years ago. It was really to help parents have the resources to help their children relate to each other and to them better, have better family relations, healthy relationships, and to be able to solve emotional challenges. We've written about 45 books that are available on Amazon and also on Conquer by Love. And just short books to allow people to have some tools necessary to help their children.
And we serve clients all over the country. We are 100% virtual. That allows us to see people everywhere and even on short notice many times. So all of our meetings are on a video call like Zoom or Google Meet. We are family owned. Raz and I here are the owners at Higher Ground. We have 2 companies, Higher Ground Financial Group and Higher Ground Legal. And you may have seen us on some of these other places, some publications and TV shows and radio shows, Fox Business and Bloomberg and Kipler and USA Today.
Yeah, we've gotten around a little bit.
Yes.
All right.
So, and then you can go to our website, riskfeestaxes.com, to learn more as well. And what do we do for our clients? Really, we focus on those 3 biggest killers: taxes, risk, fees. If we reduce or eliminate those, everything else gets better in retirement. You have higher income, you have better protection, you pass more to your family. And then, Raz, we are fiduciaries. That means we're required to act in your best interests.
Except today. So right now this is a class. We're teaching general information. We don't know any information about you. So we can't give you specific information to you about you. So as a fiduciary, we cannot act in that sense. So this is more general information, and hopefully you get an idea of what we can help you with, and we'll make an appointment, and we'll see. All you got to do is click that link, and you can get on our schedule as soon as you want.
All right. So when we put together a plan for our clients, we want to show them what a difference it makes with us versus without us.
Right now, out there on your own, your life expectancy is like here. With me, it's here. Without me, here. With me, without me. With me, without me. So, I would advise going home, but it's up to you.
So it's not really your life expectancy, it's your money's life expectancy.
Just to be clear, we're Tom Cruise in that picture.
Yeah. So we want to help you keep more of your money and lose less of it to risk, fees, and taxes, and be able to spend more of it and be able to give more to your family.
And so anybody recognize this guy? If you do, put him in the chat, in the comments.
Immediately people know this is Data. It's amazing how famous this guy is without even the full picture, right?
Yes, this is Commander Data, the android from Star Trek, and I'm a huge Star Trek fan, so I love having this picture in here. The first picture, though, if you're not a Star Trek fan, the first picture was only insufficient data.
Ha 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 ha.
Yes, more where that came from. Insufficient data leads to poor choices. We want to give you proper and complete information to make good decisions about your money.
So we're going to go fast, and there's a lot of information. Just take note, and you can also replay it on a slower thing by going to YouTube, and we have it listed there as well.
All right. So what is a tax? This is a tax seminar, right? So how do you define tax? Well, if you look up in the dictionary, there's a number of definitions, but one of the very important ones is it's really a heavy or onerous demand on resources.
So these are your resources, things that you worked for and accumulated, and some things taking it away.
And there are three main types of tax that affect you in retirement. Market risk, that's a tax. The advisor tax, the fees, and federal and state taxes as well. The actual, what you think of as taxes,
right,
is only one of the three types of tax that really affect you in retirement.
Most people focus on federal, state, and local taxes, but they miss that market is a tax. If you lose 40% in the market, that's a tax, and you got to grow from where it is now. It's gone.
Exactly. So we're going to discuss all three of these types of tax, and we are going to focus heavily on federal taxes as well, and some of the changing tax laws. You'll see that in a few minutes. So what is this can?
This is a can. Everybody recognizes this. It probably got it in your cupboard at home. And so the story behind a can is Napoleon wanted to conquer the world, but he could not conquer the world unless he could have his food last longer. So he put out a contest, and somebody came up with this can to be able to preserve food so that he could conquer the world. And this can worked. It was sealed. It was great. It stored food for a long period of time, but there was something missing from this can.
What was missing? It preserved food well, right?
Yeah.
The lid's on it, it's sealed tight, and your food's safe.
So the problem is there's no way to open it. They give you a hammer and chisel and say, open it. And not for another 50 years was the actual can opener invented. And so what that means is that you got pieces of metal and dirt and gunk into your can with a hammer and chisel.
So what does it have to do with your money, though? I mean, this is kind of off track, isn't it?
Well, not really. So you've been working and putting your money aside for the last 50 years into your IRA, 401k, TSP, anything you've been saving money, and now you got to take it out. But you want to take it out without contaminating it, without giving most of it to the IRS or and taxes, fees, and risk. You want to make sure that it lasts for your lifetime.
All right. So our agenda for today, we're going to talk about those risk, fees, taxes, and we'll talk about the new tax laws and some of the ones that are coming up soon. And we'll have time for some question and answer, but most likely just put your question in the comments, and then we'll try to get to you when you schedule a meeting with us. We'll be happy to talk to you then. All right. So we had a bear market in 2022, a couple years ago now, and a bear market is when we have a drop of at least 20%. And why do I have this on here, even though this is from a few years old now almost? Well, it's because this was a very short bear market. It recovered about a year later. And by the end of 2023, we recovered most of it, which means if you did not take any money out of the market for 2 whole years, 24 months, you would have about the same amount of money at the end of the 24 months that you had when you started. Well, that's great if you didn't have to spend money. But what changes when you retire? You have to spend money every year, and that's really key. You need to know where you're going to get your money from, and you can't sell low. They always say buy low and sell high, right? So when the market's crashing, and it will crash again. When is the next crash? Well, if I knew that, I'd be a trillionaire. Right. So we don't know exactly when the crashes are happening, when the bull markets or bear markets are happening, but we do know they will happen. Think about how old you are, how long you're likely to live. You're probably going to experience several more bear markets during your lifetime.
Yeah. So this is just the most recent bear market. There's been lots of bear markets, and we just highlighted the most recent one. We'll show you some more in a little bit.
And then inflation. You haven't heard this word recently, have you? Inflation. It's all over. There's no inflation. Well,
yes.
There is still inflation, but what can you use to your advantage for inflation? Look at rental properties. In Miami particularly, over a 2-year period, they went up by 39%.
So that's something you can hedge against inflation. If you were to invest in real estate and have rental income, doesn't mean you have to be a landlord. You have to be an investor and have it managed by somebody else. But you could take advantage of the higher and increased rents while your costs remain essentially the same.
All right, and then bonds. Usually you move to bonds when the stocks are losing, right? But that did not work well for the last few years.
Yeah, this last few years it did not work at all, because what happened was we had such low interest rates that when people moved to bonds and the interest rates started going up, they started losing money, because you could get a new bond at a higher interest rate. Why would you want yours? So you have to discount it. And when you discount it, that means you lose money. So a lot of people lost $2 trillion in a bond market, and there was huge losses there.
And it may change a little bit as interest rates start to move down eventually, but it certainly has not done well recently. And so then this guy, Jerome Powell, the chairman of the Federal Reserve, he said inflation would be temporary. And then he said a year later, we now better understand how little we understand about inflation. So,
and he's in charge.
He's supposed to be fixing it, right?
Right.
So how do they fix it? Well, this is the federal interest rates.
Right. So this is federal funds rate, and it looks sort of like the stock market, and it should, because look at it. It starts off and the interest rate keeps going up. They keep raising interest rates until 2000 dot-com bubble. So what happened is it became too expensive for companies to borrow money, and they started collapsing. Then the Federal Reserve started lowering rates, went down to about 2004, and then they realized, okay, we got to raise rates again. So they started raising rates again until they forced the market to drop, and that was a double crash, 2008. So that's why it lasted a little bit longer. It was the housing market and the stock market, and they lowered rates really fast and got it down there because it was a bad time. It was a recession. And then 2016, they started raising rates again. Said, okay, enough of the fun. Let's raise rates again because the market's getting out of control. Started raising rates again, and then we had a crash in 2020 when COVID started. That was the shortest crash in history. It lasted about a month. And the reason? Because the federal government printed $2 trillion and dumped it into the market, and immediately we had inflation. That's what I was taught in economics in high school, right? If you print money, you're going to have inflation. Too much money is going to cause inflation.
But what do we not see at the end of this? We don't see a big drop yet, right?
So the interest rates are going up, and everybody said, oh, it's going to drop, it's going to drop. But the market has not crashed yet. So I don't think they can drop the rates until the market crashes.
And they may drop a little bit. You see some of that. Your rates coming down a little bit. They stay flat. They go up a little bit, come down a little bit. But the actual big drop in rates, they're waiting for a complete market crash to be able to do that.
Right.
And how big could it be? I mean, Harry Dent, this investment manager, thinks 86%. That's pretty dire. But even Morgan Stanley is saying the commercial real estate crash that's coming is going to be worse than 2008.
Yeah, there's a lot of commercial real estate that's empty. People don't want to go back to work. They got used to working from home during COVID and stayed at home.
So those properties are worth a lot less.
Right. I just saw an article in San Francisco, a building that was worth $96 million sold for $9 million just about a month ago.
That's crazy. But over the long term, the market's going to go up. It'll recover. We'll be fine, right? Eventually, it'll go up.
That's what investment advisors want you to believe, right?
Yeah. So don't, when you're losing money, it's only a paper loss. It's only a paper cut, right?
Yeah. So imagine if you were bleeding, Daniel.
Yeah. If you're bleeding and you get a big cut and blood is gushing out everywhere, so we rush you to the hospital. And
I said, let me patch it up. Come on, let me patch it up.
No, doctor, wait till the blood comes back in my arm. The blood that I lost, it's on the floor. Put that back in my arm first, and then you can stitch me up.
I think you might have a head injury too. I mean, this is ridiculous. You don't ever say that to the doctor to put your blood back in. And that's what a lot of people say is, hey, we lost money, but don't worry, it's just a paper loss. It's not really there.
You can make more blood or get a transfusion afterward, but what blood you lost is already gone. So same thing with the market. When it crashes, you have to grow from there.
Yeah, there's no such thing as a paper loss.
So this is the actual S&P returns from 2000 to 2022. So 22-year period, the first 22 years in this century.
It looks pretty good. It looks like it grew a lot.
Yeah, it did end higher. And if you were riding out the market, put a guess in the comments. What do you think the average return was for the S&P 500 for 22 years?
12%. 17%.
8%, 6%. These are a little more reasonable.
Yeah.
But it's even lower than that. 4.28% is the average rate of return of the S&P.
That sounds too low. I mean, I'm pretty sure I got better return than that.
Well, you probably did. And you know why? Because you've been investing money for the last 20 plus years. When you invest money, that's where most of your money is. And not from the growth on it, it's what money you put in and your employer matched. So count up all the money in your account and figure out how much you put in and your employer matched. That's most of the money, not a whole bunch of market growth. You may have gotten lucky and picked a specific stock that went up a lot. Some people did. But the majority of people, they get this return, and it's only about 4.5%. Now, what could you have done? Well, before we get to that.
Why is
that? We lost 50%. And Raz, how much do you have to gain to get back to even after you lose 50%?
Not 50%. If you lose 50, you got to gain 100%.
100% return just to break even.
And that took several years.
Then we lost 50%. We had to gain 100% to break even after the 2008 crash.
Again, it took several years to get back. So it's 13 years of zero return.
And that's just risk. Remember the three killers: risk, fees, taxes? We haven't even gotten to fees and taxes. Already zero return for 13 years. Yeah. And this is why, I say, what could you have done? If you knew that going in, you could have bought a 20-year treasury guaranteed in January of 2000 for 6.86%.
Wow.
And think about that. If you had $1 million in 2000 and you decided to leave it in the market for 20 years, you'd end up with $2.4 million. So it did grow, but that with all the up and downs in the market,
all the heart attacks.
Or 20-year treasuries, you'd have $3.7 million at the end of that time with zero market risk, no heart attacks, the safest thing you possibly could have done. And that's where we said at the beginning, risk and reward are not always linked. Sometimes they are, but in this case, the least risky thing you possibly could have done gave you much better return.
And the closer you are to retirement, the less risk you want to take, but you still want to grow your money. So let's take a look at some different ideas that can help you grow money and still reduce risk.
So again, you can click the link to make an appointment with us. We'll be happy to talk to you specifically, give you fiduciary advice.
There's no cost to the appointment. You make an appointment, we'll answer your questions.
So imagine this dog that is being taught how to play the shell game. And its owner says, "Can you find the treat?" "Oh, is that it?" "Oh, congratulations, you found the treat. And now look what you missed out on."
Oh, man.
And
that's awful.
Now look, he's going to spit it out. He doesn't want that anymore.
So we kind of feel like that too. We picked the wrong stock, we put the wrong time period, and that's the whole thing. You're always picking things, and you can pick wrong. I mean, when I go grocery shopping, I try to find the lane that's moving fast. As soon as I get in, it slows down. It's like never works. So, anyways, we can't cry over spilt milk. So we want to make sure we make better decisions going forward to make slow and steady growth.
And so, Raz, people say, I just cherry-picked that slide. I picked a perfect time with 2 market crashes in 13 years. Of course it's going to look bad.
I mean, a market always does 12% on long term, doesn't it?
That's what they say. But look at this. Every 15-year period since 1996, only once was it even above 8% average.
So we average taking 1 year off, put 1 year on. 1 year off, put 1 year on. So 15 years, and it all averaged down this.
And average of all the periods is only 5%. And there were some that were even below 3% average return.
Yeah.
So again, it is really important to realize how much the market actually does do and does not do. People say, well, even that is only back to 1996. Let's go back further. Look at the 13-year period of zero returns we talked about. But then look at that. Before that, we had a 26-year period of zero returns. And before that, we had a 52-year period of zero returns. Imagine putting $1 in, waiting 52 years, and still having just $1 left. Now, this is inflation adjusted, so it went up a little bit, but only to keep pace with inflation. That's it.
So why do people invest in the market? Well, originally what happened, the reason for the market was you would buy a piece of a company and share in the profits, dividends, right? And that's how people used to be. So those 52 years, people made money because it doesn't include dividends in there. But what happened is then pensions were taken away, and the federal government pushed the 401ks and the IRAs and the TSPs. And since all the money's going in there, now the valuations are higher for those companies when they really shouldn't be.
And a lot of them are paying less dividends or no dividends now compared to before. Yeah. And so the original reasons for the investing in the market still sort of exist. There are still some dividend-paying stocks, and that may be a reason to be in the market. But in general, just to buy in for hoping that it's going to grow up, that's not really great for retirement planning. So we talked about bear markets already. I said loss of at least 20%. On this page, we have every single bear market since the great stock market crash in 1929.
So it's not just the recent bear market we just talked about. There's been a lot of them. And it happens just about every 5 years and lasts about 1.5 years. And the average loss is about 39%. And that's a pretty high percent to lose every 5 years.
Yeah. It takes 1.5 years to get to the bottom and 5 years to recover. So you could go 6 years or more with no gain at all. And this is just historically speaking.
And that's averages, right?
Yeah.
So it could be longer, it could be shorter, but that's average. And when you retire, you could go through 5 or 6 of these time periods. And that's crazy.
So you need to have a plan for where do you get your money from. If it's all in the market now, where are you going to get your income from in those bad years? Because the bad years will come. They may come tomorrow, they may come in 5 years, but they are going to come.
Yes.
All right. So how do you protect from that? So what do you do normally? You diversify, right?
Right. So you have a boat. I have all my money floating in the market. It's there, and my advisor said, "Hey, let's diversify because it's kind of scary to put it all in one boat." So I get 4 more boats. Now I have 5 boats. That's pretty well diversified, right? No, because if a tsunami comes, they're all in the same pond. So what is diversification?
True diversification is there's a couple kinds. One is tax diversification, which we'll get to in a few minutes. But true asset diversification is really opinion-based assets versus contract-based assets. So what is an opinion-based asset?
So opinion-based is based on somebody else's opinion, market, okay? So if you want to sell your house, it's based on what the market's doing, what other people's opinion of your house value is. And same with the stocks, bonds, mutual funds. All that is based on somebody else's opinion. Your car, it's all based on somebody else. Even gold and silver is based on somebody else's opinion.
It's what I'm willing to pay for it, not what you think it's worth.
Right.
And then what about contract-based asset? What is that?
A contract-based asset is based on something that's written and agreed upon. So if you deposit $10,000 in your bank account, that's a contract. They can't turn around and say, "Hey, sorry, Daniel, we only have $3,000. The value is only $3,000 now." So what? This is cash. That's the contract. Yep. So they can't change that on you. So
and there's other contract-based assets. You can have an insurance contract that's contract-based.
So banks, CDs, Federal Reserve notes, long-term notes, and insurance contracts and rental agreements. They're all contracts.
So a rental property, but rental property is opinion-based for the value of the property.
Right. But so it's how do you want to invest in it? If you're speculating about growth in the property, that's one thing. But if you've got a rental agreement, you're getting income every month.
So that's a contract.
That's a contract, absolutely.
So you want to be diversified between opinion assets and contract assets. That is true diversification. Don't have all your money in things that are valued by somebody else's opinion. So you should know the value.
Again, insufficient data, you'll be in the same pond. You got to get out of the same pond, get into different ponds.
All right. So we talked about risk. So the first type of tax is market risk, the market loss tax. And what can be even worse depending on the time period? It could be fees.
Yeah. See, in a market loss, so you're at least participating in the growth, right? In the fees, you don't participate in anything. It's just gone. And you'd be surprised how much people pay in fees.
And most people, if they have an advisor, they pay around 1%, some a little less, some a little more. But if they have mutual funds, they're also paying mutual fund expense ratios. There's trading costs, there's cash drag, there's a lot of other hidden costs and fees. When you add them all up, it says it could be up to 5.5. Most of our clients, when they first come to us and we analyze what they're paying in fees, we find they're paying between 3.5% or so in fees.
And these are not our numbers. They're from New York Times, Forbes magazine. These are numbers that are across the country.
And so really high fees can eat away your portfolio. But let's say you don't have high fees. You only have 1%. Yeah. It really is just a 1%
So what does that mean? So I got $500,000. I'll come to Daniel. He's an investment advisor. And I said, Daniel, what can you do for me with my $500,000? What can you do for me?
Well, let's say that in this hypothetical situation, I can beat the market. Remember, the market did only 4.28%. I'm going to give you 5% because I'm a wonderful advisor.
Right.
And that's going to be better than the market.
What does that mean to me?
$1.2 million of total growth.
That sounds pretty good, $1.2 million.
And for that, I'll charge a 1% fee.
That's reasonable. I mean, I'm going to get $1.2 million. 1% is not a big deal.
Well, let's count it up. When you add up the account for these 25 years, you pay a total of $217,000 in fees.
Wow. Now we put it that way, it seems like a lot of money.
Yeah.
And if I pay $217,000, then that's not in my account anymore, right?
Exactly. So if you add back in what you could have earned on those fees, you really lost another $159,000. So really, $376,000 is the total loss to just a 1% fee.
That's crazy.
And so think about this. You had $1.2 million of total growth. Mm-hmm. You take away the fee costs. That is 31% of your growth that went to fees.
That's crazy.
Not 1%. 31% of your growth went away. And it was only a 1% fee. So does this mean that all fees all the time are bad? You should never pay a fee?
No, not necessarily. I mean, if you're getting something for that fee, the fee is worth it. People are allowed to make a living, right?
So now might be a good time to talk about what impact a tax attorney can make in your retirement plan. So most people, they work with an advisor, they're supposed to pick different stocks and mutual funds, and you hope it grows over time, and they may or may not be beating the market, but and many times they're not, and you're still paying them a fee. But are they giving you tax advice? Are they giving you advice to minimize your taxes for the long term? Look at the last email you got from your advisor. Look at the last statement you received. All the disclosures on the bottom, the fine print. What does it say? This is not tax advice. This is not legal advice. We do not provide those things. You need to talk to a proper tax attorney.
And Daniel, what does your email say?
My email says this is tax advice. This is legal advice. You can rely on it for actionable information.
The exact opposite of most advisors. So with Daniel, you have that information. You'll have actual actionable advice.
It's because I am a tax attorney. That's what we specialize in. Okay, so here's an example of Bob and Carol. These are actual clients, but they're not their real names. They had $1.6 million in assets, but their pension and Social Security covered most of their basic stuff. They wanted to travel, but they weren't sure how much they could spend without running out of money.
So they're afraid of spending money because they had several things that could cause the problems. I mean, market crashes, unknown expenses.
But they were sure the fees were not an issue because they were only paying 1% to their advisor.
Absolutely.
We found they're actually paying over 3% in fees, which is $49,000 every year in fees.
Wow, that's a college tuition every year. Wow.
Yeah. And they were also exposed to a $790,000 potential loss in the next bear market. That's why they didn't want to spend the money, because they knew they'd have to gain 97% just to break even.
Right. They lived through a couple of bear markets. They didn't want that to happen and ruin all their money.
So we were able to reduce their fees to $17,000 a year, which is a $32,000 savings every year. And we also reduced the risk. So now they know the most they could lose in a worst case scenario is about 9.4% or $150,000. That's much easier to recover from. Now they feel a lot more confident spending money, enjoying retirement, traveling, and still having plenty left for the kids. So that's risk and fees. So now we got to taxes. This is what you came here to hear about, right? The first two are also types of tax, but the most famous tax is this federal tax that we have to pay. And we're going to talk about the tax law changes and what's coming up in the next few years.
But Dan, I know you like politics, but we're not going to talk about politics today.
Yeah, we're not going to talk about the election. We're not going to talk about the things that could happen or should happen or might happen. Only that's the things that are already on the books. And then
when they change, you talk to us again. We'll know the changes. We'll explain the changes.
So first of all, you will pay taxes. Resistance is futile.
And Daniel loves to slide. Why? 2 reasons. One, he's a Star Trek fan. And number 2, he's a tax attorney. So that doesn't mean he likes taxes. He just likes to know that if taxes have to be paid, let's look at the rules and figure out how to pay the minimum amount that's possible. And that's what Daniel
You have a choice. You can pay on your own terms inside the government.
In fact, one of the federal judges had said that you have no obligation to pay more in taxes, even 1 cent more than what you owe.
Exactly. And so let's use this example. Forget taxes for a minute. So, Raz, let's start a new business together. I know we have higher ground financial.
No. I'm going to start the business.
You're going to start the business.
And you're the mafia. And you just take a piece of my protection money, right?
Okay, but it's only 25%.
Yeah.
Okay,
so you're not doing anything in my business. I'm doing all the work, and you're taking 25%.
But I own 25% of your business.
Yeah.
Okay, but you know what? Don't pay me now. Don't pay me anything. I just own 25%. But I also write the contract in the business partnership. And so 20 years go by, and your business is doing really well.
I've grown it. I've done lots of money.
And now you're reading this contract that I made you sign 20 years ago, and you find out I have the ability and allowance to change the percentage I own of your company whenever I want.
You go to 35, you can go to 15, you can do whatever you want. I have no choice in the matter.
And you don't have to sign anything or agree to anything.
Right. So you haven't really contributed anything to my growth, but you're able to change and take whatever you want out of my
So,
company.
Raz, how soon are you dissolving this partnership?
I want to get out as soon as possible.
Exactly. So, same thing with the IRS. If you have even $1 in a 401k, an IRA, a TSP account, all these retirement accounts that are pre-tax, that means you have this contract with the government. You have a partnership with the IRS that says, you know what? I'm sure, I know what the taxes would be if I paid it today, but I'm not going to do that. You decide what the taxes should be. 30 years from now, I'll pay whatever you want, Uncle Sam. That is not a good solution. It's not a good business to be in. So we want to reduce and minimize that, and you can do it.
What are the tax brackets? Most people, you can Google these tax brackets. You'll see what they are and what they're going to be. In just 2 years, they're increasing, right?
In 2026, they're going to start increasing from 12 going to 15, 22 going to 25, and so on, and because the Trump tax cuts are expiring.
So that's not the whole story, though.
No, the brackets are also going to shrink because these brackets that we have today are not the same brackets sizes that they were in 2017 or 2016. So here's what happened in 2026 when they expire. Then they go back, and the exact size bracket has not been determined yet, but it should be around this. So let's take a look at the 24% bracket, for example. It's highlighted here. If you're married, you have $201,000 of income, you're in the 24% bracket. But you have up to $383,000 of room in that bracket today where you could do a Roth conversion or something else and not pay any more in taxes. But what happens in 2026, Raz?
That bracket shrinks all the way down to $282,000. And that leaves $100,000 less room for you to convert to Roth or do anything else.
So not only are you now in the 28% bracket instead of 24, but you also lose $100,000 of room in that bracket. So if you have a decent income, 300-something thousand, you might move up 2 brackets, not just 1. Yeah. And that's a really big deal. Nobody's talking about this. A lot of articles have been written about the tax brackets changing, the percentages changing, but the actual size of each bracket will also be changing.
Yes.
And look at that top tax bracket. Right now, you can have up to 700-something thousand before you're in the top bracket. In a couple years, it's going to be 569,000. That's a huge difference. So keep that in mind. You only have a couple of years left to do make some big strategic moves to minimize your taxes. They're on sale right now. Pay them while they're on sale. Now, how do long-term capital gains brackets work? And this is, again, for a couple years, and this is going to be linked again to the regular income brackets after a couple years. We'll still have 15 or 20%, but the bracket sizes are changing.
Yeah, so most people think, it's 15% you got to pay no matter what on capital gains. Not necessarily true, because if your income, and that means your Social Security, and if you have Roth income, then you have room up to $120,000 after the $5,000, $26,000 general deduction, you're down to $94,000. So long as that's there, you're not paying any money on capital gains. So you sell some Apple stock or Microsoft stock, there's no gains so long as your income is below that.
So it's possible to be in a 0% tax bracket.
Yes.
Now, the real tax system is more complicated than just the brackets, because if you just need the brackets, you can Google that. You don't need a tax attorney.
There's required minimum distributions, there's capital gains, there's Social Security benefits, higher Medicare premiums, Roth conversions, 3.8% net investment tax. There's so many things to look at that it really gets kind of overwhelming and confusing.
So let's talk about Medicare premiums for a second. Did you know that if you have too much income, maybe from a Roth conversion or something, you could have a lot more cost for Medicare, maybe even $1,000 a month for Medicare?
Isn't that what's called IRMA?
IRMA, exactly. So why in the world would you intentionally drive up your income to do Roth conversions in order, and then also have to pay so much higher Medicare costs?
Because you got to look at the big picture, all right? The small picture is you're paying higher Medicare costs. The big picture is Daniel's going to save you over $1 million in taxes. So pay the extra Medicare costs with the tax savings.
Only for a couple of years during a transitionary period. Medicare costs only go up during those high income years, then they go down again.
Once you solve that high income problem, the getting the taxes paid, then it just takes about 1.5 to 2 years to get that back, Medicare premiums back down to what they're supposed to be.
So what I look at is a total tax savings over your lifetime. I really couldn't care less if you pay more or less tax today. What I care is you pay less tax overall. And that's the difference between a CPA and a tax attorney. CPAs are all about how much can I save you now, today. Defer.
Yeah.
Kick the can down the road. It's not kicking a can down the road. It's rolling a snowball down the hill. It's getting bigger and
They
bigger.
should really be called defer PAs because they don't really save anything.
But I mean, there's some that are more useful in certain situations, and you should have a good CPA and accountant. But where we come in as a tax attorneys is to minimize your taxes for the long term.
Right.
Okay. And so how do RMDs work, Raz?
RMDs, it's a 4-letter word for most of our clients. RMDS, right? 4 letters. Now, RMDs are, you got to take money out. You've been putting aside, you've been kicking the can down the road, and now, well, it used to be 70.5, then 72, and now it's 73 for most people. And then if you're under 65, it'll be 75 before you take RMDs out. And what that means is required. The federal government is requiring you to take money out and pay taxes. They said, you've had enough fun. Now I want my money. So what do? You take your whole balance, let's say it's $1 million, and then you divide it by your life expectancy. You may not know how long you live, but I guess the IRS does. It puts a number on it, 26.5%.
So 26.5 years.
Yeah, 5 years. So you got to divide your $1 million by 26.5, and you come up with about $37,000, almost 4%. And that's what you got to take out. Every year, though, move the chart, every year you divide by a smaller and smaller number. When you do that, you have a bigger and bigger number coming out. Okay, so you got to take more and more of your money out, pay higher taxes, and it pushes you in a higher tax bracket whether you want to or not, and you got to take it out.
Exactly. And if you don't want to, you still have to take it out, but you might also have penalties.
Yes.
So definitely take it out. And there are some ways to avoid that, because if you make it Roth, then there won't be any RMDs. We'll talk about that in a few minutes. Capital gains. What are phantom gains?
So some of you might have gotten a 1099 and you didn't spend any money from your stock market. What happened is your portfolio manager or fund manager might have sold some highly appreciated stocks inside the fund and bought something else. But he or she does not pay the capital gains. They pass it on to you. So they send you a 1099, whether you took the money out or not. They send you a 1099. You got to pay the capital gains on it. Those are called phantom gains. And then rebalancing also triggers that. Most of you probably have your account set up to automatic rebalancing, which is a good thing because it does help you preserve your money and also increase your value. But that'll also cause phantom gains. And long-term gains can create ordinary income tax. They can have a cascading effect. You start getting those long-term capital gains, they start pushing your income tax higher. So you got to take a look at the whole picture, and that's why you need somebody like Daniel. So make that appointment. It only takes a couple seconds. Make that appointment, click the link, and it is free, and we'll answer your questions and hopefully give you some ideas on how to save money.
Then there's this 3.8% net investment income tax. It's on top of all the other taxes, and that's over higher income or investment income.
So if you're making $250,000, they're going to charge you another 3.8% on top of whatever you're already paying on net investment tax. And this is the one tax that could go higher. I know we said we're not going to talk about political, but this is the easiest one. They keep saying tax the rich, tax the rich. Well, this is taxing the rich. Whether you like it or not, you're considered rich if you're in this income bracket, and they can change that to 5 or 7 or 10 or 12%, and they can get away with that.
All right, so now we have Social Security. Let's talk about how it works first, and then we'll discuss taxes. So first, you have a choice of 62 to 70 to start Social Security.
I heard you should take it wait as long as possible because it make more money.
That's what most people say, but it's not actually correct. In many cases, those of you watching this webinar probably should be taking it as soon as possible, and we'll talk about the why. First, let me tell you what I mean by as soon as possible. 66 or 67 is your full retirement age. You cannot take Social Security if you're younger than that and you're making more than $22,000. So make sure you either retire or you're wait until full retirement age, but then you should take it as soon as possible, and we'll explain why. Now, other types of income like rental income or passive income, the investment income, pensions, those don't count towards the $22,000 limit. It's only earned income that counts.
And your spousal income doesn't count.
Exactly. So why is it that we say take it early? Well, there's three reasons. First is taxes.
You mean you pay less taxes if you take out Social Security earlier?
I was annoyed to pay any tax at all. I thought this was going to be tax-free because it's a tax coming out of my paycheck now, and when I get it, it's going to be taxable now. You're telling me later? That was
Daniel,
crazy.
you're so young, you probably won't even get Social Security, so don't worry about paying a tax on it.
So for me, it's just a tax. That's even worse, actually. So how is it taxed?
So we got provisional income, so it's taxed differently than your regular income. You take your Social Security, 50% of it, ordinary income, dividends, capital gains, non-taxable interest, all of that, lump it together, and then they come up with a formula to show you how much of your income is going to be taxed. And whether you're single or double or married, you have brackets up to 44,000 married couple, and you have 85% of your Social Security will be taxed. So at least 15% will be tax-free.
So at all times, 15% of it's tax-free. You can really use that to your advantage.
So what does that really mean in reality? So let's take a look and study this. So Daniel, if you're retiring today and you need $60,000 worth of income, and you decide, hey, you're going to take $20,000 out of Social Security and you're going to postpone your wife's Social Security.
So we could each take $20,000, but I'm choosing to let her wait and get it more income later.
And you'll take $40,000 out of your IRA.
And that'll make the $60,000 I need altogether?
Yeah. And so according to this, about $11,000 of it will be taxable. That's 55%. But I'm going to retire at the same time, and my wife and I are going to both take Social Security at $20,000 each and not let it grow.
So you'll take $40,000 from Social Security.
And only $20,000 from the IRA to have the same $60,000 income.
So that means your IRA lasts longer. You're not spending it as fast.
Right. And I'm not spending as fast, and my taxable Social Security is only $4,000 instead of $11,000. What does that really mean?
Well, on the tax return, I'm paying $2,500 in tax.
Which is not really too bad, right?
$60,000 of income.
Yeah. But I'll pay zero with the same amount of income because taking Social Security is more tax favorable. And in fact, if you look at the third line down, $24,000 is, and then $26,000. So I could actually have room for another $2,600 I could take out without paying any tax at all.
Exactly. So you could be $5,000 richer every year that you take it early.
Only because I took Social Security, both me and my spouse at the same time. So there's a tax reason why it may make sense. Now, again, this is not fiduciary advice. We got to take a look at your specific situation, see if it makes sense for you.
So what are some other reasons? Well, let's look at a break-even analysis. If you take it at 62 and you're turning 62 today, with the most you could get is about $2,500 a month. If you then wait till 70 instead, that's going to be giving you $4,500.
That's why I said people want to wait. I mean, that's almost $2,000 more per month, right?
So what do you miss out on, though? You missed $2,500 you could have gotten for 96 months. And so that's a $246,000 loss.
That means I'm giving up $250,000 by waiting?
Exactly.
So maybe you should take it now.
And it takes a long time. You will break even eventually if you live long enough. After 10 years, so at age 80, because you're getting more per month, so you're going to make up some of that money you lost. So that's how long it takes, until age 80 just to break even. But wait, there's more. If you did not need the money now, you could have invested it. Let's say you got 6% return, you have $315,000 as your total loss. Now your break even is 83. Raz, can you guess for me, what is the average life expectancy of an American turning 62 today?
Let me think. Is it 83?
It is 83. That's exactly right. So 83 is the life expectancy of a 62-year-old. The Social Security is not stupid. They want to make, the department wants to give you the same amount of money whether you take it now or later. It's exactly the same amount of money as long as you live to an average life expectancy and you don't consider taxes or inflation. So we talked about taxes. How does inflation factor in?
Time value of money. I mean, the dollar is going to be worth less in the future than it is today. So the dollar today is actually worth more.
In 2023, we got a 3.2% increase for inflation on Social Security. Think about this. Do you think we had only a 3.2% increase in actual inflation in 2023? No, nobody thinks that, except for the government, apparently. Yeah. So the point is, you're not getting as much of an increase as inflation is really hurting you. And so because of that, it's worth more to you today than it will be tomorrow.
Right.
So there's three reasons. And then so now people want to think, why is it that everybody has, everybody else, all my advisors say, all the news media says, delay Social Security. You're going to get more money. It's important.
That's for the general public. The general public is not rich.
Yeah. So if you're watching this webinar, most likely you're watching because it's a tax webinar, which means you want to save money on taxes, which means you're paying taxes, which means you're not probably making an average income. The average income in America is about $35,000. The average person at retirement has only about $10,000 saved. So that's not most of the people watching this webinar. And so that's why I'm saying for most of you watching, you probably are not the average person, so you should do things differently than the average person. That average American does need to wait as long as possible because this is the only check you're going to get in retirement. And if Social Security really is your only check in retirement, then yes, you want that check to be as big as possible, and you probably want to work during retirement at least part-time as well.
And this is not the advice for everyone. We got to take a look at your specific situation and find out what the best option for you is.
All right, so here's a case study. John and Jane, married filing jointly, age 73. They have $60,000 in Social Security, $15,000 of capital gains, and they just hit 73, so they now have $45,000
Happy birthday.
of required distributions. This is what their tax situation looks like. They're in the 12% bracket. That's the red line down there.
Yeah, but Daniel, I see this 49.95%, almost 50% in taxes.
Yeah, how does that happen? Well, the $1,000 of required distributions cause $120 in taxes. That's 12%.
That's what it's supposed to be.
But because of that, now it's causing $850 in Social Security to become taxable, also at 12%, $102. That causes $1,850 of capital gains to now become taxable at 15% for $277. So the total tax burden on $1,000 with RMD was $499.50.
Wow.
And you have no choice because it's required. And they didn't do any prior planning. Now, if you're already in RMD age, there are still some things you can do, so contact us. But especially if you're younger, you have some years to plan ahead, this is something you want to avoid. And working with a tax attorney, we can reduce and minimize those taxes.
And this is something Jeff posted on Twitter. My son asked what taxes are. So I gave him a bag of M&Ms and explained that he has to give some of them back to me. I know how much he has to give back to me, but he has to guess himself. And if he gets it wrong, he goes to prison. What a great way to explain it to a child.
Yes. So that is taxes for you. So what can you do if you are not the average person, like we just talked about? You need to do things differently than the average person. What are some tools you can use? Well, diversify. We talked about diversifying between opinion assets and contract assets.
But now we're talking about a different kind of diversification, right?
It's tax diversification.
Yeah. What does that mean?
Well, you don't have all your money in tax-deferred products like IRAs and 401k. Also, you should have Roth, non-qualified, other tax-free accounts, real estate, lots of different tax statuses of different investments.
So you mean there's accounts that I can have that are tax-free?
There are tax-free accounts. There are a number of different tax-free accounts, and there's different tax advantages for real estate and other things, for example.
And the reason you have it diversified is because depending on what the tax situation is, what the tax environment is, you can pick and choose which account to take money out of to minimize your total tax exposure.
Exactly. And that way you can properly blend your withdrawals. And you should also consider, if you're going to buy a certain investment, make sure you don't just think, is this investment right for me? But also, what kind of tax status will it have? And is there a better way?
And don't buy into all this hoopla. For example, on the news, on the radio, I hear all the time, hey, you can roll your IRA, your 401k into a self-managed IRA and buy real estate. I like real estate, but is that a good idea, Daniel?
It's a terrible idea for most people. Why is it a terrible idea? Well, if you have a property and you put it inside of your IRA, you have very high maintenance and admin costs. There's a lot of valuations and appraisals you got to do. And when you have a maintenance cost, like a new roof, let's say you need a new roof, it's going to be $20,000. You can't add $20,000 into your IRA. You can only put $7,000 in. So how are you going to get the money to pay for a new roof? Well, you're going to borrow and you're going to get a really unfavorable loan because not so many banks will lend to IRAs.
Or you have $50,000 or $80,000 or $100,000 sitting in cash in your self-storage area that can't do anything.
Exactly. So what is the other problem? The biggest problem is all the best tax advantages of real estate, such as depreciation, where most of your income is tax-free for 24 years or 27 years. And then when you pass away, then your kids get a stepped-up basis and they can depreciate all over again and not pay any capital gains tax. That is all out the window if it's inside of an IRA. So I like real estate for the right client, but definitely not inside of an IRA.
Yeah.
What's another one people get backwards?
So a lot of times people at this stage in life, when they're in their 50s, 60s, and 70s, they get marketed with annuities, fixed index annuities and such, that they're designed to minimize your risk and still allow you to gain some value, and insurance companies back them up, and they seem like a good idea. So if I'm going to buy an annuity, what I'm going to do is I'm going to go to my broker and say, hey, I'm going to sell this Microsoft and Apple stock. Yeah, I know I'm going to pay capital gains, but I want to move it to annuity because annuity is perfect for me. That's
not a good idea in most cases. And why? Well, you're paying capital gains when you didn't need to. Then you buy the annuity, then you're going to create income tax later, which is worse than capital gains tax. So that's
So the
not really
annuity
a solution.
itself is not a bad idea.
No, but if you were going to do it, use your IRA, because moving from the IRA to the annuity is still an IRA. It's just a different custodian.
Yeah, so you come at everything with from a tax perspective, not just is it a good idea or not is going to help me.
So using your IRA for that, there's no tax on that transfer.
Perfect.
At all. And then when it comes out, it's income taxable, but it could even be tax-free if it's Roth. So whatever investment you're thinking of, make sure you also pick what is the best tax status for that investment.
Right.
Okay? And then we talked about rental properties. Get ahead of the game for RMDs.
That means you don't have to wait till the age to have the RMD. You can take money out earlier and do something with it.
Exactly. And use Roth conversions and CRUTs. And these are two really cool strategies which we're going to share with you right now. So what is a Roth conversion?
Well, most of you in this webinar probably were not able to put money in a Roth because you made too much money. And but you do have the option. If you're still working, you probably have the option. In fact, you have to have it by the end of the year. That there's a Roth option in your 401k, your TSP, your 403b, and all of those. And what that means, you just go to the contribution section, change the contribution from traditional to Roth. And when you put it in Roth, yes, you pay a little more taxes now, but it grows completely tax-free. You never pay taxes again. So pay taxes up front, never again.
But what if I'm not really working or contributing anymore, but I have all this IRA money?
You
Is
can
that anything I
convert.
can do?
Yeah, you can convert your IRA to Roth. You pay the taxes now, make it Roth, and whatever it grows to from now on will be tax-free. You're not in business with the IRS anymore. Now you're in business for yourself, and whatever grows, you get to keep.
So what's this 5-year rule I keep hearing about?
Well, 5-year rule is if you're under 59 and a half, you got to wait 5 years before you can access your Roth once you convert it.
Okay.
But if you're over 59 and a half, hey, you can take, if you convert it, you can take it out the next day if you like and spend it. What you can't do is the growth. So, for example, if you convert 100,000 from an IRA to Roth, then you don't need it. So let it sit there. And 2 years later, your daughter's getting married, you need some money, so you can take the $100,000 out, but the 20,000 that it grew, you can't take that other 20,000 out. That has to wait for 3 more years until the 5-year rule's up.
All right. And then there's no RMDs. So if you have it in Roth IRA, there's no required distributions.
Isn't that crazy? None.
And your kids can inherit it then tax-free, and they can even wait 10 more years before taking the money out.
They have nothing else really besides life insurance that they can let money sit and grow tax-free and never have to pay tax on it.
Exactly. And so it's really important. Now, the worst type of thing you can leave to your kids right now is an IRA, but the best, or one of the best anyway, is a Roth. So make sure if you're going to leave the IRA, you try to convert it.
Either spend the IRA or convert it to Roth.
So how much will you actually save by doing Roth conversions? Well, thank you for asking. I can explain here. Here's an example of a client of ours who had $1 million in her IRA. She was going to just leave this to her daughter. And we calculated, she's 60 years old, she's going to end up paying $523,000 in taxes just on required distribution.
During her lifetime.
Over her lifetime. Then she's going to pay another $200,000 in reinvestment tax because she doesn't need this money. She has pension and Social Security. This money is going to go to her daughter. But then when the daughter gets it, at $434,000 is another tax bill the daughter pays when she dies, when the mother dies. So that's $1.1 million in taxes that you are owed, and the account balance is only $1 million.
That's crazy.
It's because it grows, you pay tax, it grows again, you pay tax, it grows again, you pay tax. You never catch up.
So what's the solution?
Well, if we convert to Roth, $300,000 is the max. That's the most she's going to pay, and that's it. All the growth for the rest of her life is tax-free. The daughter inherits tax-free. Again, it is a huge deal.
But if I convert a whole $1 million, I'm going to be in a much higher tax bracket. It's going to cost me a lot of money.
So we do it over stages. We do it over a few years, or we use some other creative deductions like a CRUT to help with that. So we'll talk about that in a minute. But huge tax savings, $850,000 of tax savings. And you know what? This does not assume the taxes go up at all for the rest of your life. That's probably a bad assumption. We expect taxes to go up.
And we'll show you a slide on that later. But you got to have a game plan. You got to figure out how to minimize your taxes.
So click the link, schedule a meeting with us. We'll be happy to give you advice on what you can do.
So now we're coming to CRUT. CRUT is a charitable remainder unit trust, and that's where you need an attorney to just drop the trust. But what does that actually do? It's if you have highly appreciated assets, stocks or depreciated rental property or a business you're going to sell, and if you do that, you're going to end up with capital gains. Now, with the rental property, you can do a 1031 exchange. I mean, you got to buy another rental property. If you don't want to be in the rental business anymore, you want to get out, you got to do 1031 exchange. The other option is you can put that to a CRUT or even part of it into a CRUT, and there's no capital gains.
So you donate your stock to this charitable trust that we set up.
Before you sell it, and then when the CRUT sells it, there's no capital gains at all. And you get a one-time huge tax deduction of about 50%. And that depends on age. The older you are, the bigger the tax deduction. That tax deduction, you can walk that over to your IRA and convert your IRA to Roth without paying any taxes.
Wow.
And the limitations, you can do up to 30% per year of your AGI, and you can carry it over for up to 5 years. And then there's a 5% income, a pension for you for the rest of your life, that you get 5% income guaranteed for the rest of your life. What a deal.
So when you die, whatever's left in the trust, that has to go to charity. So if you don't have any particular charities that you like, you can also leave it to your own charity. It's legal to donate to yourself as long as it is a correct charity.
I've kind of heard of the Bill Clinton charitable foundation.
The Clinton Foundation, the Trump Foundation.
The Gates Foundation.
The Bill Gates Foundation, the Kennedy Foundation. So there's plenty of these foundations that are wealthy people have, and you don't have to be wealthy to have your own charity. So you could leave it to that if you want, or if you like your church, you can leave it to your church as well. But there's huge tax benefits up front. So let's talk about that. We'll use an example. Let's say a client has $500,000 in Microsoft stock that she bought 20 years ago.
83 cents a share.
Yeah, and now it's worth millions. And so she wants to sell 500,000 of this. And if she sells it, she's going to pay capital gains of more than $100,000. So that's not a great solution. Instead, she sets up the trust with us. Then she donates the $500,000 to the trust. And then
stock.
the trust sells the stocks after the donation. So then you don't pay any capital gains. That saves $100,000 off the bat. Because she's 65, she gets a $222,000 charitable deduction on top of that. So she takes that over and makes her IRA Roth with no taxes at all. Then she gets $25,000 a year for the rest of her life as a pension. And she says, well, I already have a pension. I don't really need this money. Why don't I buy life insurance with it for $1 million? So now she takes the $25,000. She buys life insurance for $1 million. Her kids get the $1 million tax-free when she dies.
Wow.
Her church gets $500,000 from the trust when she dies. And in the meantime, she get all the tax benefits up front, avoid the capital gains, get an income tax deduction, make her IRA Roth. And all these things, everybody's a winner except for the IRS.
And the crazy thing is, the IRS allows you to do it. It's written in law. You can do this. So you got to know the rules and play by the rules.
Exactly. So how high have taxes been historically? Take a guess. What is the top tax bracket we've ever had in this country?
Right now it is, 37%?
37 is current. So put in the comments. Somebody says 40, 60, 85. Are we in a communist country, 85% tax?
Sounds crazy.
The highest actually was 94%. You're close. And 94% was the highest tax bracket ever in the history of this country. And that was back in World War II time frame, but even after that, it stayed at about 90% for a while. It was at 70% for a while. That's what usually shocks people about the slide. But look at the rate on a lot lower, only $10,000 of income. Back then, it was 40%.
Yeah, so imagine you're only making $10,000 in retirement. That's almost nothing, and now you're paying 40% taxes when you were only paying 12% earlier. So
the bracket itself might be higher even if you're in a lower tax bracket. So keep that in mind. Again, insufficient data causes undue stress. We don't want you to be stressed every time. If you're getting the impression that I'm trying to stress you out, I'm not. I want you to have a stress-free retirement.
Identify the problems and let's put a solution together.
What are the 3 biggest stress causes in retirement? Risk, fees, taxes. If we remove those, everything else gets better. You have less stress. Excuse me.
All right, so legacy planning, estate gift tax. So what is that? I mean, you have estate taxes too, right? If you've got a lot of money and you die, then you pay a lot of money in taxes.
You got a $13.6 million exclusion per spouse in 2024.
I don't have that much money. That's okay.
So if you got less than that, then you don't have to worry about the estate tax. But in a couple of years, in 2026, it's going to drop in half to about $6 million or so. And anything above that number when you die is going to be a 40% tax on excess. And you might be thinking,
I've already paid taxes on this stuff.
Oh yeah, but you got to pay tax again, 40%.
Wow.
Now you might think, well, I don't even have $6 million. Well, maybe you have $3 or $4 million, but you're growing it faster than you're spending it. By the time you pass away, you may have more than that $6 million. So you really do need to plan for estate tax if you're in that situation. And the crazy thing is, they calculate the estate tax first on all of your assets, even though you have not paid tax on the IRAs. You pay tax on all the assets for the estate tax. Then you pay tax on all the IRAs, even though half of them are gone almost for the estate tax.
Yeah.
So you double tax on your IRAs. It's really crazy. Now, what can you do? You can give away money ahead of time and use the exclusion that you have today. And you have $18,000 exclusion per beneficiary every year. Now, that doesn't mean you only can give that. You can give more. You just don't have to report $18,000.
So I could give you $1 million, and I don't pay taxes. You don't pay taxes. I just got to report it.
Exactly.
That's it.
So talk to us if you have some estate and gifting plans. Now, how do you transfer wealth smoothly? Well, you need a will, a trust, power of attorney. These are basic type stuff. Why is it that you need a trust and you don't need just a will?
Well, a will just tells the court what you'd like to see happen, but a trust creates a separate entity that doesn't go through probate, so it stays private. Nobody knows how much you had in assets, and nobody knows anything about what's going on.
And it's much more efficient and transfers quickly instead of taking months or even years for probate court.
Right.
So then there's different types of trust. Everybody.
So the biggest thing is if you have any real estate, any properties at all, you really should have a trust.
Exactly. But there's other types of trust. There's irrevocable life insurance trust, intentionally defective.
Really?
Yes, intentionally defective trust. That's a real thing. SLATs, special needs trust, Medicaid trust, all these different types of trusts, which are useful for certain estate planning needs, but they don't apply to everybody. So talk to us, especially if you have somebody with special needs. They can't inherit money, otherwise they'll be kicked off any government benefits they're receiving.
We don't really like Medicaid planning, giving all your money away and then pretending to be poor so you get on Medicaid and you get whatever bed is available. We don't like that. I think there's other solutions that are much, much better for you, and we can take a look at it to show you how those will work.
Okay. And then there's CRUTs, which we talked about. So all these are different types of trusts. But if you have the best possible trust and will and estate plan, it's written by the best attorney in the world, and you forgot that your old 401k from 20 years ago has your ex-spouse as a beneficiary, well, when you die, she gets the other half. She already got half, now she's getting the other half when you die. So make sure you have your beneficiary designations match, because beneficiary designations trump everything. They need to match your estate plan.
Yep, absolutely.
Okay, don't forget about that. And then what types of assets are good and bad to leave to children? So real estate is great if it's in a trust, very important, and the trust needs to say what should be done with the property.
I really think it's a step up in basis, so it's awesome.
Mutual funds, stocks, bonds, same thing. No tax when you die for the kids.
And all the capital gains that you were going to pay, but it gets a step up in basis, and your kids don't have to pay the capital gains yet.
And then there's inherited IRAs. These are the worst possible things to leave to your children, because the Secure Act, a new law from a few years ago now, says kids have to spend all that money within 10 years. They cannot stretch it over their lifetime. So in their highest earning years, when your kids are likely to inherit from you, they have to add all this IRA to their income, and it's going to cause them massive taxes. Inherited IRAs are a terrible thing to leave to kids right now. Best things are Roth IRAs or life insurance. These are the most tax-free, the most efficient, the least amount of headache. But why do I keep saying you must have a trust? Besides skipping probate, let's say you put all your house, because some states, many states, you have a beneficiary deed. You can make your house a beneficiary, so your kids automatically get it. Still goes outside probate. But why would you not want to do that? Well, there's 3 kids.
They look happy now.
I want to sell it. I want to rent it. I want to move in. But all their names are on the deed, so they can't agree, and then this is what happens.
And they were happy before, so you don't want to cause undue stress on their lives and their families. And things change over the time period. They could have spouses, they could have kids, they could have divorces, anything can happen, and you don't want this to be a problem.
So the trust should say the house must be sold, or the house may not be sold, but you choose instead of your kids, so they don't have the fighting.
Right.
All right, so we talked about the other and the biggest tax of all, which is market risk. You have to have that handled in retirement planning. Long-term care costs, inflation, these are other risk factors and other sort of taxes that can be in retirement, which we'll talk to you about one-on-one when you make an appointment. One more thing, boomerang children. This is another pitfall.
You raise your kids, you paid for all their clothes, their food, their housing, they paid for the college, you send them off, you launch them, and they come back.
So here's a solution for boomerang children.
The kids won't move back home if they can't find it. So, all kidding aside, guys, this is really designed to help you understand taxes and your situation a little better. So and hopefully you enjoyed our little talk here.
Well, what happens if you decide, this is interesting, I want to hear more about the 3 killers, risk, fees, taxes.
So what's the process?
When you click the link and make the appointment with us, then a stage 1 Zoom call. It is a Zoom call or Google Meet.
We're going to assess your current situation. We're going to take a look and we're going to ask you about your dreams, what you want to do, identify all the risks, and then we're going to say, hey, we can help you or we can't help you, and then you can decide whether you want to go to the next step. So and this is free. There's no cost.
No cost for this. Okay. Mm-hmm. So stage 2 is a pre-qualification offer. Remember, with us, without us, with us, without us.
So if you decide to move forward and get that, we have to figure out exactly what the current situation is. We got to identify all this, the tax, the risk, and fees in your situation, and put a plan together. Then we put an income plan discussion. We do a estate plan discussion, and clearly identify what it costs to work with us. And this is a $6,000 value that, because you're on this webinar, we're discounting it only at $500, and that is refundable. So if you find that you didn't find value in what we did, it'd be $500 refunded. So this part is just to find out, get a clear, exact picture of what your current situation
is. And Raz, after you do that, do you have to work with us? Are you required?
No.
Do we take all the information and go do it yourself?
Yeah, you can take it, do it yourself. You can take it to your advisor, do it there. Your CPA, it doesn't make a difference, but at least now you know where all the holes are, and you can fill them.
And to be clear, it's different for everybody, but most of our clients that go through this process, we're able to save them more than $1 million in taxes. They're able to increase their income by up to 50% or more. And they retire. If they're not retired already, they can retire 3 to 5 years sooner than they would otherwise be able to do. So
with more income, usually.
You with more income. So if you decide you want us to help solve those things, then we'll talk about products and services and things like that.
Then we'll spill the sauce. We'll tell you what the secret ingredients are, what exactly the details are, and then we start making small changes. It doesn't mean you got to move all your money to us. It doesn't mean you got to leave your advisor, but it means that you got to stop the losses from the risk, fees, and taxes. That's where we can really come in and make an impact.
So again, click the link, make the appointment. We'll be happy to talk to you one-on-one on a Zoom call, and I can't wait to see you.
And in the first meeting, if you just have a couple questions about this or that, hey, we're going to answer them for free. There's no cost to that at all.
All right. See you soon.